growth rate for the S&P 500. And then I'm going to test you and see if you know how to do it. Giuliano, did I give you the CFA challenge worksheet for the booklet?
The one we sign up on, or the?
No, this one.
No.
So you know what it looks like. Anybody else? Did I give you one of these?
Oh, I'll pick one.
You want one anyway? Who knows? I might get you hooked and you could always be on the as an alternate. You're on the fringe.
Thank you.
So let's do the 1 year, which is easy. This is going to be the average annual compound growth rate. And you might want to take notes on this. This is the way I do it. So give me the index level for the S&P 500 as of January 1st, 2019, please.
I think it was 2,510.
2,510,
About, yeah.
like that. And then what was it in January 2018?
$22,680.
What is it?
2,680.
Got it. All right. So what's that ratio? What's 2510 divided by 2680?
0.93.
What is it?
0.93.
0.93. And what if it's 1 to the 1? This is 1 year. Here. So that's going to be what? 0.93? Right. And what's 0.93 minus 1?
Minus 27.
What is it?
Minus 27.
Like that.
0.07. Not bad. 7%.
0.07 times 100, 7%. Now what we're going to do is we're going to do the S&P 500. This time we're going to do January 1st, 2019, which we already got. And we want to do the S&P 500 January 1st, was it 2016, 18, 19, 18, 17, 16, so 3 years. All right? And then we're going to do this right here, 1 to the 3 years. Minus 1. Times 100. The math gets a little easier when it's positive. So we already know what the January is. was the S&P 500 on January 1st, 2016? Everybody following here? Okay, keep going. Everybody should be not like writing, they should be click, 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 looking for the data. Okay, Yahoo Finance, stock charts, big charts.
1,940.
What is it?
1,940.
And 40, like that?
Yes.
Got it. And then to the 1/3, because you're doing 3 years. And was that come out to be what, 0.333? So what's this ratio turn out to be? What is this? What's 2510 divided by 1940?
1.39.
What is it?
1.39.
1.39 to the 0.333. Does everybody know how to do exponential calculations on their calculator? Launch a calculator or get out an Excel spreadsheet. If you want to borrow a calculator, I left it in my box. You got to be able to do this in Excel, and you got to be able to calculate it on a calculator. If you don't, then you're going to run into problems when they ask you to do this stuff at the company. So what's 1.39 to 0.333? 1.115 minus 1. 0.115 times 100 is 11.5%. Can you double check that for me and make sure we calculated it correctly?
It's 1.29, not 1.39.
Okay. I've got 2 people with opposing information, so I'm not going to, as a managing director, I'm not going to take it. I need confirmation from at least another 3 or 4 people.
That's right.
Okay, perfect. Thank you. All right, so what's 1.29 to 0.333? 1.08. Okay. So it's 0.08, which is 8%. Give me 2 decimal points.
896.
Oh shoot, so it's really 9.
Yeah.
It's really 9. I'm just gonna round up. So 9% average annual compound growth rate over the last 3 years on the S&P 500. Okay, is that correct? Because 18 was pretty bad. Okay, so it dragged down the performance. Let's do the 5th year, 5 year. 1, 2, 3, boom, boom. 1 to the 5th. Minus 1 times 100 equals. Okay. We know that this is 2510. All right, and then what was it? So 19, 18, 17, 16, 15, 14. So what was it in January 2014?
1831.
1831. What's 2510 divided by 1831?
1.065.
1.065. What's 1.065 to?
That's the CAGR. Yeah, I already know that.
Go ahead. What's this divided by this?
1.37.
0.37 to the 1/5. Was it 0.25?
1.065.
This is 1.065.
Yep.
Minus 1, 0.065, and 100. 6.5. So as you can see, once you get to here, you don't need to do these last 2 steps, right? So once you get 1.065, you know it's 6.5%. So you don't need these 2, right? If you want to do it really quickly, you don't need it. All right, and then how about the 10-year? January 2009. So we know that this is 2510. Am I losing anybody? Am I losing anybody? Are you lost? Do you know what we're doing? Okay. I just got it. And then what was the base?
932.
932 to the 110. So what's this ratio?
2.69.
3.69. If we take it to the 0.1, we, what do we get?
1.104.
1.104 minus 1, 0.104, or it's 10.4%. Does that make sense? Yeah, it totally makes sense, because we know that the average annual compound growth rate on the S&P 500 has been between like 8 and 10%, going back 10, 20, 30 years. So if you're getting these weird numbers, then you probably did something wrong in the calculations. Okay. So what you want to do now is go into your 1 year worksheet and plug in the S&P 500 number. And then go into your 3-year, your 5-year, your 10-year, plug that in so that the alpha is calculated off the performance of your portfolio. Okay? And then what you're going to do is you're going to use the portfolio memo that I sent you. There's a static portfolio memo that I sent you. Just fill it in. Okay. The performance. Use the $2 billion portfolio. Use on a static portfolio, you could probably get 100 to 50 basis points. 100 would be a pretty large asset management fee on a static portfolio. You know, I would just use 100 for right now. So obviously, you know, $2 billion at 1%, you're looking at $20 million a year, you know, in asset management fees. That's pretty good, right? So 20 million, Goldman gets half, we get the other 10. I'm going to pay myself 2 million, and then you three, my three CFA, MBA analysts are going to get $1 million each. Is that cool? And then the government will take half, so you'll only have to live off of like 500,000. Okay. But you'll own real estate and depreciate stuff, and you know, get deferred comp, and you know, try to minimize your taxes. Okay, so are we all clear on this? Okay. Any questions on the pretest? Everybody have the right regression equation? Y hat equals alpha plus beta hat 1 x1 plus blah 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 to beta hat 5x5 plus the error term hat, which means they're estimates in the regression. That's why we do it that way. Everybody know what a time series regression is? Time series, one company, multiple factors, such as financial ratios. We're trying to forecast return on equity. One company, financial ratio factors over time. Okay? If it's a cross-sectional, we're doing just one time period, maybe an average 4 quarters of financial ratios across multiple firms. Okay? Sometimes you got to use cross-sectional regression because you don't have enough time series data. But the coefficients will basically be the same. Okay? External validity is you built the model, you back tested it, you forward tested it, it seems to be working. You were using peer-reviewed journal articles and industry research to basically build the model. Internal validation is you talk to experts internally within the firm, and they also gave you input on what variables should be in the model. How do you correct for multicollinearity? I got 2 variables in the model that are highly correlated to each other, but also correlated to the dependent variable. How do I make the decision which one to keep and which one to throw out?
What's in the literature?
Yeah, the one that's been cited the most in the literature, theory, you know, industry and academic research. So you throw one out and you keep the one that's most valid, even though the beta or the t statistic may be weaker than the other. It's more theoretically correct. Okay. Did that answer all of your questions? Does everybody understand what type of risk you can diversify away?
Systematic.
Is it systematic or unsystematic? That you can diversify away. I'm basically building a portfolio of stocks whose returns have no low and negative correlation with each other. The more stocks that I add to the portfolio, whose returns have low, no, and negative correlation.
Unsystematic.
Yeah, what's left over? Systematic risk. If it's market risk, then what's the measure that we use as a reflection of market risk?
Market security.
You're actually really, I think it is, but what's the slope called? What's the slope? No. When you run the regression on the returns between the market and the stock, you're going to get a what coefficient? A what type of coefficient? No, you can run the correlation. I would run the correlation first, but then I would run a single variable regression equation between the stock returns and the market returns, and I'm going to get the coefficient's going to give me what? Got it. Okay, it's going to give you the beta. Okay, cool. Anything else? I think everything else is pretty straightforward, isn't it? Yeah. And then on the, any other questions on the pretest? And then for the, we did the first question, didn't we? We talked about why the Federal Reserve hadn't been able to hit its targets. It hit its targets on unemployment, but they didn't on inflation and GDP. So using the quantitative theory of money, what was the number one factor that was basically causing them to miss their targets in the quantitative theory of money? What is the quantitative theory of money? Can you tell me what the equation is? What is it? Real GDP
Times the inflation rate.
times the inflation rate equals velocity of money times the money supply growth rate. So the Fed is pumping printing all kinds of money, pumping up the money supply growth rate, holding inflation constant, but is not able to hit its GDP targets, then what's happening? So money supply is going up, V equals inflation times real GDP, holding inflation constant. What's happening? Why isn't GDP hitting its targets? Because the velocity of money is collapsed. Okay, same thing with if you hold GDP constant and you're trying to target inflation and your velocity of money collapses, you're not going to be able to hit the inflation targets. So they have hit their GDP targets recently in the first quarter. They did last year 3%, but this year they're looking at basically 2% or 1.7% on GDP. So we're decelerating pretty rapidly in regards to GDP. And we did hit the 2% CPI targets or core inflation targets, but unfortunately that's also starting to slip. Okay. So what should the Fed do? If you're Jerome Powell at the Federal Reserve, you sit on the open market committee, what would be the monetary policy that you would recommend? What would you recommend? If you're not hitting the inflation, holding velocity constant, if you're not hitting your inflation or your GDP targets using the quantity theory of money, what should you be doing?
Raise the money supply.
Yeah, you should be increasing the money supply. And then once you print the money, what are you going to do with the money? Once you print the money, what do you do with the money? You're going to do what? Yeah, the Fed's going to do something with the money. They're going to print money and buy treasury bonds. And that's going to cause bond prices to go. How's that work? When I buy something, does that increase or decrease demand? If I buy something, increases demand. So what's that going to do to prices? Go up. So bond prices are going to go up and interest rates are going to go down. Got it. And stimulate the economy. Okay. So I think that was kind of what I was getting at, because I was kind of racking my brain for like 8 years trying to figure out why the heck the Fed had been pumping all this liquidity into the system and there'd been no effect on core inflation or GDP. Okay. So all of a sudden I was in my bed and all of a sudden the quantitative theory of money flashed in front of my head from my master's program at San Francisco State from Dan Wenzel, and I started playing with the numbers. Okay. So what's the problem right now? Let's take it into reality. What's the problem right now with monetary policy? And what did Trump say yesterday and the day before? What was he screaming at Jerome Powell and the Feds for?
Wasn't the lower the rates.
Because what's the problem? What's going on right now? What? No, it hasn't, right? But what's going on in regards to monetary policy?
Inflation. Tariffs?
No. Where's the yield curve? Is it normal?
No, it's inverted.
No, it's inverted. Okay,
We're
so
trying to fix it.
what's higher, short-term interest rates or long-term interest rates?
Short-term.
Short-term interest rates are higher than long-term interest rates. Is that good or bad? No, that's bad. So what does Trump want? Does he want lower short-term interest rates or higher short-term interest rates? Lower short-term interest rates. And if the Fed starts lowering short-term interest rates, what's going to happen to the yield curve?
Hopefully back to normal.
It's going to go back to normal. Okay, and there's very low probability of a recession when the yield curve is normal. But when we start to go into a recession, the Fed starts printing money, buying up short-term treasuries, driving up bond prices, and driving down interest rates. Okay. So that's why they're screaming right now, because the yield curve inversion is a predictor of recessions. It's been like 100% accurate since the 1970s. And you can go back to the 1940s, and you can go back before World War II.
How long has it been inverted?
It's been probably a couple months now, depending on the measure. The measure that they use is the 2-year and the 10-year, okay? But the 3-month and the 6-month and the 9-month has been inverted. And if you look at the curve right now, it looks like this.
Yeah.
It looks like that. So basically the market, it's inverted here and then normal out here. So the market, if you look at it, the market is anticipating a recession within the next 2 years. Because the curve's gone down and the inflation expectations have gone down based on the Fisher equation. Okay.
It has to last for a whole quarter though, right?
No, you're thinking of recession. A recession is negative. You get negative GDP for 2 consecutive quarters. Would technically be a recession, but usually the lagged effects from the reporting, it does not make that an accurate indicator of recessions. Usually recessions can actually occur up to 2.5 years prior to 2 negative GDP numbers. So it's not a very good measure, even though that's what I think it's the business cycle monitoring service or something that says. So let's keep going on this thing. So we already did that. We said yes, that the Fed hit its GDP targets in the first quarter of I'll be writing this down on your thing, okay? Unless you're gonna go back and watch the video, so I'm gonna be looking for all the stuff on your exam. That's where we're going over. So they did in 2018 and they did in the first quarter of 2019, but they didn't last quarter. GDP was at 2%. And if you look at the long-term GDP average annual compound growth rates, it's been well below the 3% potential or target, okay, which is disinflationary and deflationary at the end of the day. Did they hit the employment or unemployment targets? Yes. Unemployment rate is what, 3.7 right now? The natural rate of unemployment is around 4 or 5, so they've actually exceeded their unemployment rate targets, but the unemployment rate is a horrible indicator of labor market slack. Because people roll off of the employment rolls. If you're not actively looking for a job and you run out of your benefits, they basically take you out of the numerator. Okay, so it's an artificial number. The true unemployment rate is double or triple the reported rate. Okay, and labor participation rates are at all-time lows at around 66%, and all-time highs have been around 76%. Okay, so there's a lot of white males between the ages of 45 and 65 years old that are out of the labor force, along with Hispanic men and African American men, because most of those are incarcerated, in the prison system. And then the people between the ages of 15 and 20 are usually high school individuals, so there's very high unemployment rates for them too. So you really got to look at the stratification of the socio-demographics to get a true picture of what the unemployment rate really is, or underemployment rate, or labor participation rate. Yes.
Does that account for people that retire early?
No, their category, I don't think that because it's working age population is what labor participation is looking at. Okay, so they wouldn't be in it once you retire. But the
But
people who,
say you retire at like 45, say you
well, you're not actively looking,
Right, so
you're not
so you're pulled out
participating
anyway.
in the workforce. All right, so let's keep going. And inflation targets. So the average inflation rate over the last 10 years has been 1.7, 1.5%. The target's been 2. We're running at about 2 right now, but the true inflation rate is actually underreported by the core. So the Fed is targeting 2% core inflation rate, but the true inflation rate is really based on you as the individual. So your parents are putting you through college. Your parents' inflation rates are extremely higher than the reported rate because college costs and school costs, along with food and housing, has gone up way more than the 2%. It's probably gone up around 10%. So your inflation rates or your parents' inflation rates are significantly higher than the reported. Although the Fed is saying that they have hit the target recently, but haven't hit it on average over the last 10 years. Okay. If we were to fall into a recession, would the Fed use negative interest rate policy? The answer is yes. What did Trump say the other day? 2 days ago, or yesterday in a tweet? Yeah, he wants negative interest rates. Okay, so basically you have the executive president basically telling what the Federal Reserve to do, okay, which is a major problem. And he's saying you should do it because the Europeans have been doing it, which is probably not a good, more of a monkey see, monkey do type policy
So if you're doing
recommendation.
negative, then what are we supposed to use when we're in a recession? When the Fed has no.
They say you're supposed to use fiscal policy, but you're at 22 trillion already with structural deficits of $1 trillion a year, so you can't use fiscal policy. So you can't use monetary policy because you'll probably go into a liquidity trap if you've read Keynes's work. So you could drive interest rates to negative, but if everybody's scared, they're not going to consume and they're not going to invest, which is it's a circular thing that makes things even worse. Okay, I think they could probably ramp up the balance sheet again from 3.7 trillion back to 5.7 trillion, so they maybe have a couple trillion, in their wallets to shoot using accommodative monetary policy or quantitative easing. They could always lower the reserve requirements, but they could also take the federal funds rate and other short-term rates negative, which isn't good for the banking system. Okay.
Didn't it ever peg long-term interest rates or no?
They do target interest rates, but under Milton Friedman's, theories of monetarism, you don't do that. You target the money supply growth rate and you let interest rates fluctuate around supply and demand for loanable funds.
Do you think our yield curve is impacted by the fact that Europe has basically negative interest rates, so a lot
Not
of
yet.
investment has come in, so our.
Not yet, but if we do go negative, it'll probably go 0 first. We get to a normal curve, and then we could go negative at some
So
point.
where are Europeans pouring their money then, like bond holders?
They're just scared. It's precautionary balances. I mean, they're willing to pay the tax, on the negative interest rate bonds and to put the money into bank accounts, particularly those who have large amounts of money, of putting money in their Swiss bank accounts, and they're actually paying a negative interest rate. So now you're getting charged for putting money into short-term government bonds and into bank accounts, which basically turns modern finance theory on its head. That's why we're talking about it.
Yeah, why wouldn't they buy American bonds then?
Huh?
Why wouldn't they buy?
They are.
American
That's why the dollar's appreciated significantly against the euro.
Wouldn't that affect our yield curve though? If a bunch of foreign investors for the first time come in because their bonds are basically negative?
Yeah, but the Fed is liquidating the balance sheet. They've gone from $5.3 trillion in short-term government securities. They've been trying to unwind through a quantitative tightening period. So they've been selling off short-term securities, which inverted the curve.
Yeah.
And they wanted to continue to keep the curve inverted because this is where the majority of the demand for treasuries is on the short term, because it's short term and highly liquid and extremely safe. So I think they ended up selling off too much, which inverted the curve, along with very low unemployment rates and fairly healthy GDP growth rates. So as the money moved in from negative interest rate sovereign bonds in other countries, it's actually caused the dollar to appreciate, but not enough to cause the curve to flatten or turn normal.
So if the Fed's inflation target's 2 and our 10-year's like 1.9, are we already negative?
You're negative real, negative real rates, which is, you haven't seen negative real interest rates since 2007, 8, 9, okay? Which is an indicator of a recession, okay? So let's keep going. So the answer is yes. Okay, so you want to write that down. And what would be the impact on the economy? Well, if interest rates go negative, what's the cost? What happens to the cost of capital? If you have negative interest rates, let's say you have a yield to maturity on a bond equals some kind of risk-free rate plus these risk premiums, trying to get to the yield on the bond. So I'm going to use a illiquidity risk premium. I'm going to use a credit default risk premium. I'm going to use a maturity risk premium. And I'm sure there's other risk premiums that you're going to tack on. So this would be your cost of debt. Okay? And then if I was going to do my cost of equity, what equation would I use? I'm going to calculate the cost of the equity. What equation do I use? What equation do I use when I calculate the cost of equity for a firm? Got it. So I'm going to use the capital asset pricing model. And what's the capital asset pricing model? I'm testing you to see if you guys learned anything in 123. Got risk-free. Yeah. Internal market minus the risk-free. Got it. So this answers that next question. So if the risk-free rate goes down, what happens to the cost of your equity and your debt? Goes down. Got it. And if we're using the weighted average cost of capital, that's the discount rate. And we're using the capital asset pricing model, that's the discount rate. And I'm going to take some kind of cash flow. T+1, I'm going to use just a simple model. So if my WACC goes down, my CAPM goes down, my cost of debt goes down, what happens to the value of the stocks? Goes up. Okay. So there's really two areas, and I could turn this into a Gordon growth model if I wanted to. There's only two ways to cause stock prices to go up, right? It's either increased earnings per share in the future, right? Or it's going to be lower cost of capital. So over the last 10 years, the Federal Reserve has basically printed, $5.3 trillion, went out into the bond market, bought up all those bonds, drove up bond prices and drove down interest rates. And the effect was what? What happened? The economy grew because the cost of capital basically went down, which made it cheaper to borrow, right, for individuals to consume and for corporations to borrow to invest. So it basically stimulated the economy. What else did it do? So yes, it stimulates the economy through the transmission mechanism of lowering the cost of capital, okay, and the cost of borrowing. Okay, and then what would be the impact on asset prices? It would go, if interest rates, risk-free rates would turn negative, what would happen to the cost of equity and debt? It would go, if the risk-free rates went negative, what would happen to the cost of the equity and the debt? It would go down. And if the cost of the equity and the debt go down, what happens to the value of the stocks? It goes up. Okay? And what about real estate? I'm using net operating income. So if interest rates go down, what happens to the cost of debt and equity? It goes down. What happens to the value of real estate? It goes up. And if the interest rates go down, what happens to bond prices? If interest rates go down, bond prices go up. Got So if you see, if the Fed drives interest rates negative, what's it gonna do to the cost of capital? The Federal Reserve drives interest rates negative, what happens to the cost of capital? It goes down. Are you gonna consume and invest more, or consume and invest less? You're gonna invest more and you're gonna consume more, okay? You're gonna consume more because your credit card bill, I can now get a credit card for 5% instead of 15, okay? So you're gonna consume more and you're gonna invest more, which would be stimulative to the economy in the short term. You need to write this down, in the short term. But at some point in time, people are gonna say, I'm not consuming, and businesses are saying, I'm not investing, because negative interest rates is an indicator of disinflation and basically a recession. So why would I consume when I'm gonna get laid off? Okay, I'm not gonna take on more debt if I know I'm gonna get laid off. And businesses aren't gonna build new plant and equipment and expand their markets if they know we're gonna go into a recession. So at some point in the medium to long term, it doesn't work as a one-shot deal. What would it do to savers? Okay, you're buying US government bonds all the way through to the 10-year maturity with a negative interest rate. Are you happy?
No.
No. Is it good for you?
No.
No, because you're paying basically the government to basically buy their bonds, which again flips finance on its head. Actually, what you're doing is you're buying a lower standard of living, because you're not really getting anything on the coupon, and you're getting less on the principal. So you're actually basically paying the government to hold their bonds. You're getting liquidity, but you're not getting any return over time. So that intertemporal substitution doesn't really work. What does it do for investors?
Wait, don't you want to invest?
Huh?
You want to invest?
Well, this is the point. If I'm lucky enough to be that top 90th percentile or the 70th percentile that actually owns real assets or financial assets, such as stocks, bonds, and real estate, and the Fed goes into a negative interest rate policy, what's that gonna do to asset prices for these real and these financial assets? It's gonna prop them up through monetary policy, not through cash flows, but through artificial inflation of the assets through over-accommodative monetary policy and unorthodox monetary policy.
Isn't that just going to cause a worse recession?
Yeah, when the bubble bursts.
Yeah.
Because that's what the Japanese did. They drove their interest rates to zero and negative to try to prop up asset prices and created actually an asset price bubble in real estate and stocks. And when it popped, they've been in a recession for almost 15, 20 years now. So it didn't work. It works for a while, just as long as you continue to print more money to inflate the prices. But at some point in time, you know, if you're running into fiscal budget constraints, or you run into monetary policy constraints, at some point, when you pull that liquidity from the market, asset prices are gonna react quickly and violently.
But this only works at the national level, it doesn't work internationally. Because if only the Federal Reserve does this, then maybe you are artificially putting up all the real estate and stocks value, but for example, European investors are not going to invest because they're going to stay more or less the same.
Yeah, part of the problem is the U.S. Federal Reserve is the world central bank.
Okay.
Okay, and you saw that in the financial crisis under the Dodd-Frank Act, that basically under the Freedom of Information Act, Bloomberg basically petitioned to the Fed to get the reports, and they found out that the Federal Reserve in the United States was printing money and buying government sovereign bonds around the globe to inject liquidity on a global basis to keep the whole globe from going into a depression. Okay. So now there's monetary policy coordination around the Federal Reserve and the ECB.
Okay.
Although they're doing negative interest rates. We'll see what Lagrange does. Christine is coming. She'll probably do what Draghi did, was print a bunch of money, buy a bunch of corporate bonds, stocks, and sovereign bonds. And actually the Federal Reserve, Janet Yellen basically said before she left to run a scenario where the Federal Reserve actually bought corporate bonds and corporate stock in a worst case scenario. Imagine the Federal Reserve going into ownership of basically the corporate sector. this is all new stuff. We've never studied this stuff, 5, 6, 7 years ago. It's totally different. So it needs to be brought up in these finance classes. And then the impact on savers would be pretty bad. The impact on investors would be pretty good, just as long as they continue to print money and drive down interest rates and keep them negative for quite some time. But eventually the cash flows would be impacted due to a deceleration in the economy at some point. And then businesses would benefit in the short run because of the falling cost of equity and the weighted average cost of capital and the cost of the debt. Okay. And that's what businesses did over the last 10 years is they basically borrowed at near zero debt, in their debt, leveraged up their balance sheet and used that money at very low interest rates to buy back their stock. And basically prop up earnings per share, prop up their stock prices using an accounting method, which is still kind of a Ponzi scheme too, to basically do that. Okay. How much time do I have?
15.
Okay, using the Fisher equation, what variables drive risk-free rates and nominal interest rates on U.S. Treasury securities up, down, shifts the yield curve up and down, and flattens and inverts it. So what's the Fisher equation? Basically states that nominal interest rates equal, and this is the simplified Fisher equation. Can you look it up? Do you have a computer? Probably take you 2 seconds to do it.
Isn't it 1 plus I, like that? Are you talking about
Yeah, I'm
the
not doing a geometric Fisher equation, just a simple. It's the same variables, but it's more accurate to use a geometric average.
Isn't it then the rate?
What rate?
Risk-free
What
rate?
is it? What? Okay, this is the nominal interest rate, got it. The real rate, got it. Got it. Plus what?
Inflation.
Inflation or, what's the correct terminology?
Expectations.
Inflation expectations, got it. Do real rates move daily? Or do they move cyclically or secularly? Say it. Cyclically or secularly? So basically it becomes a constant in the short term. So what drives nominal interest rates up? Holding real rates constant.
The inflation expectation.
Inflation expectations. So if inflation expectations go up, what happens to interest rates? Come on, you guys. This is so
It goes
simple.
up.
Goes up. I need everybody to be talking, okay? I can't have just, one person basically answer all the questions when you all should know this. This is just review. If inflation expectations go down, what happens to nominal interest rates? They go down. Got it. Okay, excellent. Now, if the inflation expectations go up across maturities, across the curve, what happens to the yield curve?
Can you say that again?
Yeah, if inflation expectations, these are maturities, right?
Yeah.
1 year, 3 year, 5 year, 10 year, 20 year, 30 year. Now, actually, I think it's Mnuchin that wants to issue 50-year bonds. Okay, 50-year bonds. All right. So if inflation expectations go up across all maturities along the yield curve, what happens to the yield curve?
Shifts up.
Shifts up. Got it. And what if inflation expectations across the curve shift down? What happens to the yield curve? Goes down. Got it. All right. Excellent. And then if inflation expectations go down, the yield curve shifts down. Got it. And if the yield curve shifts down, what happens to bond prices across the yield curve? Okay, if the yield curve goes down, what happens to bond prices?
They go down.
How's that work? So I got the coupon, I'm just gonna use in perpetuity. So if the interest rates go down, basically values go down, is that correct?
No.
They go up. Got it. So if inflation expectations across all maturities along the yield curve shift down, then the price of government bonds are gonna go up. Okay? And if the yield curve shifts up, what happens to government bonds? Bond prices?
Go down.
They go down. Okay, got it. I'm not asking, you know, stuff, what I'm doing is I'm trying to train you and test you to be able to answer these questions very quickly, okay? Because all this stuff flows right into the derivative calculations, stock calculations, bond calculations, you know, WACC calculations to calculate present values, net present values, internal rates of return, you know, break even. Everything starts from the yield curve because it's the risk-free rate. Okay. Got it. What happens if inflation expectations in the short run start to move up? What's going to happen to short-term interest rates? So if the inflation expectations on short-term treasury securities, there's
They go up.
basically three types of markets. There's short-term bond market, short maturity, short-term, medium-term, and long-term. It's the long end of the curve, this is the short end of the curve. Okay? So if inflation expectations on the short end of the curve start to rise, what happens to interest rates? If the inflation expectations on the short end of the curve start to rise, what happens to interest rates? Okay, let me try that again because I think half the class doesn't even know what I'm talking about. If on the short end of the yield curve, if inflation expectation goes up, what happens to short-term interest rates? They go up. Got it. And what happens to the curve? It starts to what?
Flatten.
Starts to flatten. Excellent. Nice job. Yeah, it starts to flatten. And if the Fed sells off too much and drives bond prices down too far too fast, what's going to happen to the curve? It's going to
Drop.
It's going to what?
Go up.
It's not what I'm looking for.
Yeah.
If the Fed continues to sell off short-term bonds, what happens to short-term bond prices?
They go down.
They go down. What happens to short-term interest rates? How's that work?
Go up.
Federal Reserve sells off bonds. Bond prices go down. Interest rates go up. If the curve's already flattened, what happens to the curve? If they keep selling too much, then it's going to do what?
Invert.
It's going to invert. Okay, got it. We just had that conversation. Okay, got it. So the yield curve can shift up, can shift down, can flatten, and then can invert. Okay, there's no yield curve that looks like this. Okay, it's either like this or it goes like this. Okay, like that. It flops around. Okay, okay. There are basically three, four theories of yield curves. Does anybody remember what the first one was? This should all be, you guys should have been, whoever took my class last time, should have been digging around underneath their bed trying to find the last quarters or last year's pretest. See if you could dig it out. All right. So what are the theories? One,
7-minute warning.
thank you.
Yeah.
Expectations hypothesis, which is the Fisher equation. 2, market segmentation. 3, bird habitat. 4, liquidity preference. These are related to each other. Basically says that the bond market is segmented, just like markets are segmented when you're looking at consumer groups. Basically, investors are segmented by market. Borrowers and investors prefer to be in one of these segments. Either they're going to want to borrow and invest in the short term, borrow and invest in the medium term maturities, or borrow and lend on the long end of the term structure. Businesses like to borrow here on the short end because the cost of capital is cheaper. And especially manufacturers and others that hold inventory, the inventory turn forces them into the commercial paper market in the shorter term securities market. Corporations like to borrow and lend in the middle here because they like to match their economic life of their assets, particularly equipment, with the liability maturities of their liabilities. They like to match the maturities of the liabilities with the economic life of the assets. And then the long end is basically dominated by those who can basically borrow and lend on the long end. It's usually governments and well-established corporations. And if I'm a pension fund, and I know that I'm gonna have pension liabilities due in 10, 20, 30 years from now, I'm gonna be buying 10, 20, 30-year bonds to basically match the actuarial projections of when the pension liabilities are gonna be coming due, okay? What impacts do movements and shifts in the yield curve have on asset prices? We know if they go down, they go up, and if they go up, they go down. How does the Federal Reserve influence interest rates? Through open market operations on the short end of the curve. Okay, open market operations, you should be writing all this stuff down unless you're recording me. So the Federal Reserve has a direct impact on short-term interest rates through open market operations, and it has an indirect impact on medium and long-term interest rates. It's the market that usually determines medium and long-term bond rates. Yeah, the Federal Reserve has a direct impact on short-term interest rates through open market operations, and an indirect impact on medium-term and long-term maturity government bonds. Okay. What is the objective of buying bonds? To drive up prices and drive down interest rates to stimulate the economy. What's the objective of selling bonds? To drive down bond prices and drive up interest rates to cool the economy. If the Fed buys and sells bonds, what impacts do they have on bond prices? Well, if they buy them, prices go up, interest rates go down. If they sell them, bond prices go down, and interest rates go up. Does the Fed control and influence directly short-term or long-term interest rates? They influence directly short-term interest rates and indirectly long-term interest rates. Okay, so that's that question. And then I'll get into the other stuff later. So this is all review, basically, and maybe it's new for some of you, but it's basically the underlying foundation of any finance or investment. You gotta understand this stuff. Because in the book, it just uses some kind of arbitrary numbers to do the calculations with no connection whatsoever to reality. Okay. So what we're trying to do is add some application, to these theories and make them relevant. Okay. So that is it. It's really hard for us in the finance field these days, particularly as finance professors, because everything is unorthodox at this point, and finance theory has been flipped on its head. Okay? And a lot of the theories and the assumptions that have been put in place for the last 30, 50 years have changed significantly over the last 10 years. Okay? And it's interesting to see what theories still work and which ones are broken.